In my previous video, I explained the basic concept of tax harvesting. But here are certain things you need to keep in mind while executing this. First of all, this trick is not applicable on debt mutual funds. It is available only on equity shares and equity mutual funds, because the 1.25 lakh exemption available is not there for debt mutual funds. Secondly, it is applicable only on long-term capital gains, which means that the shares or equity mutual funds that you plan to sell need to be held in your account at least for a year or more before selling them. To give an example, if you plan to sell anything on 21st March 2025, you can sell only those units which you bought on or before of 20th March 2024 and nothing that you bought after that, because then that would be treated as short-term capital gain and the exemption won't be available on those sales. The third point is very important. If you're planning to harvest your tax on equity shares, you need to ensure that you do not buy and sell shares on the same day, because if you do that, those two transactions will be considered as an intra-day transaction. To give an example, if you had some shares that you bought in 2015 and you're doing tax harvesting in 2025, if you buy and sell on the same day, those two transactions will get set off against each other. So from the tax computation point of view, your purchase price will remain the price that you paid in 2015 and not the one you bought in 2025. That defeats the whole purpose of doing this exercise itself. The solution here is to buy and sell on two different days. You could buy today and sell tomorrow, or vice versa. But remember that you will be exposed to the price fluctuations that can happen to the shares on that one single day. But in mutual funds, you don't have this problem. You can buy and sell on the same day and your purchase price will get updated. In fact, if you place the buy orders and sell orders before 3 p.m., you will get the same NAV on your buy as well as sale transactions. This will completely eliminate your exposure to any market fluctuations. But here, the problem will be liquidity. When you sell your equity mutual fund, it generally takes about 2 working days for the money to hit your account. So if you want to buy and sell mutual funds worth 7 lakh at the same time, you need to have that kind of money lying around idle with you, and that can be a bit challenging. So one option is here to take the exposure, that is, you sell the mutual funds initially, wait for 2 days, let the money hit your account, and then you make the purchase transaction. The other option is to split the whole deal into multiple transactions. For example, on day 1, you could sell and buy worth 1 lakh rupees, wait for that 1 lakh to hit your account, and after 2 days when you get that money, execute another transaction for another 1 lakh rupees. So this way you will have to probably execute 7 different trades if you want to complete transactions worth 7 lakhs. This can be a bit time consuming, and hence you will have to choose one of these two options depending on your convenience. Even if your overall portfolio is in red, you might still be able to benefit from it if you're a long-term investor. If you have any investments dating back to 2023 or before, there is a good chance that those units would still be in profits and you will be able to harvest those taxes. So don't forget to record your transactions before 31st March in order to harvest your taxes for the current year.